Hi, this is Noah Tillinghast from Callidus Capital, and today I'm going to talk about the truth about set it and forget it investing. The myth is that set it and forget it works for everyone. What is true is that over a long period of time, set it and forget it works better than most strategies. However, passive investing is not passive management. These are two completely different things. And if you conflate the two, then this can lead to large mistakes in your portfolio. If you're in your 20s and 30s, let's say you have 30 plus years to recover from a large market drop, that's a great equalizer. And indeed, if you dollar cost average over time, and if you're investing during that time period and putting more money to work, then you can make a large amount of wealth in that time period. Staying invested prevents emotional panic selling, which is a common mistake for those that don't have an advisor, and it's good advice for that stage of life. Now, if you're near or in retirement, when you're flipping from accumulation to distribution, the math changes completely. For instance, if the first few years of your retirement the market declines and you're withdrawing and selling into a down market, this will hurt your retirement. And let's say you're withdrawing 4%. Let's say the market's down 30%. In reality, that's 6% of your portfolio that you're withdrawing, assuming you're increasing it by 3% a year. Now, if we look at this scenario between 2000 and 2017, this is the annual returns of markets, you can see how for 13 years the market was flat on a non-inflation adjusted basis. The S&P 500 returned 0 between 2000 and 2013. And indeed, between 2000 and 2017, on an inflation-adjusted basis, which it's obvious you have to do any math on an inflation-adjusted basis, it was 17 years. Let's say you were 60 years old and you retired, you would be 77 by the time your portfolio reached flat on an inflation-adjusted basis and started to gain money. Now, if you started investing in 2008 at near the low, then you would have made a load of money. So, for instance, in the scenario of a 20 to 30-year-old investor, they would be buying over that time period. They would be buying in 2008. Whereas if you were retired, you would be either flat or selling in terms of the amount that you owned. Now, if you, in this scenario, you can see the scenario we just went through, you can see how the index was down over that time period, over 17 years. So the idea that the index is your diversification isn't really accurate, because in an event like that, where most assets decline, even gold, if you own gold or something like that, it declined significantly into 2008. This is the position of bonds, international exposure, and cash in your portfolio. Which, if you use a set it and forget it strategy, let's say over 10 years the market has doubled, your cash allocation is the same, or roughly the same. Now, or your cash amount is roughly the same. Your cash allocation has been cut in half. You now have half the allocation that you had as a percentage of your portfolio because the market has gone up so much. So with passive allocation, stocks would just become a larger and larger portion of your portfolio, which you do not want. Now, if you're looking for a personalized strategy, index funds can be used. However, they're not a personalized strategy. They're a powerful tool, but like any tool, they have to be used correctly. I can't really talk to your specific situation in a YouTube video, but if you're interested in having a conversation, subscribe for more content, and there's a link in the description. Thanks.